Good morning, welcome to the Data Explorers stock lending briefing on Thursday the 6th of November. Firstly, regulatory news. The Tokyo Stock Exchange has announced they will require disclosure on outstanding short selling positions for designated securities as of the 7th of November. It's not clear in terms of regulations. They will require more work, and we will be putting more information on our website about that. It will be required to provide trading participants information on their outstanding short selling positions in designated securities. Not clear what designated securities represent at this stage, but we will be putting out more information on the website very shortly. Secondly, press got hold of the story that the Nasdaq watch list was down from 500 in September to just 56 names as of yesterday. I think there's a little bit of a lack of clarity around that story, in that the press have related it to lower short selling. However, naked short selling is the key word here, as people sell less stocks naked. The number of stocks on the threshold or watch list has fallen dramatically from 500 to 56. So no surprises there for market participants. Worth noting that the press have slightly got the wrong end of the stick on that one. We're hearing that the FSA takeover panel is in consultation with a number of market participants around disclosure in what they call deal stocks. Currently there are 60 deal stocks outstanding. Are those deals subject to or potentially in a merger situation or takeover situation? And they will be making some announcements probably in January around further disclosure on those names as it relates to short selling, long buying, and indeed securities lending as well. So more news expected on that one as it comes. In India, SLB, as it's referred to over there, stock lending and borrowing, has increased the time limit for securities lending from 7 to 30 days. I think that's pretty well known as of now, but that can only be good news going forward. And lastly, on regulatory news, the South Dakota voted down a measure that would have banned short selling in the state. So a massive news story there in South Dakota, obviously. We are hearing that there is quite a big post-mortem going on the effects of the short selling ban and its impact on securities lending. Data Explorers have a number of incoming requests from clients, regulators, etc., asking for a debrief on the effect of securities lending over time. So we will be putting together a paper on that in the next 48 hours that we will make publicly available, just describing exactly what's happened and the effect it's had on the securities lending market over the last several months. Stock specific now, relating to MBIA. MBIA announced a widening of their losses in Q3. The company's third quarter loss grew to $805 million, or $348 per share, from the loss of $36.6 million a year earlier. So a significant increase in the loss for MBIA. The results were worse than expected and triggered a 22% decline in the share price yesterday. We thought it would be worth looking at that stock specifically. You'll notice on the left-hand graph that the fall in shares outstanding on loan means that the fall was not picked up by short sellers. So the sentiment indicator on this one is the long selling. Looking at the right-hand side, we can see a massive fall-off in the lendable quantity, reflecting that people have been leaving the stock lending market, but more specifically, that people do not want to own MBIA, and we've seen long selling. So clearly investors are nervous around short selling, and long managers are closing out their positions or long positions in MBIA. Markets down heavily last night. I thought it's worth putting that in context of DESLI. Recession fears hit global stocks yesterday, as more evidence that the US economy is shrinking made investors brace for further declines in indices. Major European stock markets were expected to open as much as 3.6% lower today. Looking at DESLI specifically, we can see there has been a stabilisation or a stalling in the amount of inventory leaving the market, hovering in all global markets between 85 and 90%, reflecting the fact that between 10 and 15% of stocks available loan have fallen since the 1st of September, but it does appear to be flattening out. And we can expect to see people joining back into lending agents or the lending programs that they were previously in as markets stabilise around short selling and stock lending. And it is worth noting that the US is the biggest contribution in short interest currently at just shy of 140 from its original 100 on the 1st of September. So most of that rise in short interest is being attributed to the rise in shorts in the US. It's less so in Europe and Asia. And in fact, in Asia, European loan index is actually below 100. More from Desley tomorrow. That's all from us today. Thanks very much.